Hello, this is Jason Martin with Allgen. Today is 12/19/2018. I wanted to give everyone a market update. The market has been a little bit rough and very volatile recently. In fact, today we hit new yearly lows for the market. Today the Federal Reserve came out and raised interest rates again up to 2.25% to 2.5%. And the market didn't like that, and the market went down another 1.5% today, putting the S&P 500 down 5% for the year and down about 14% from its high in September. So what's causing this? What are we doing about it? What's going on? So first of all, if you look at the economic numbers are actually pretty strong right now. You have unemployment near 50-year lows. You have consumer confidence near all-time highs. You have small business optimism very high. There's a lot of positives. GDP's up, growing near 3%. So there's a lot of positives. The problem is, this is getting very long into an economic expansion. It's been almost 10 years since we've had the last recession. And the economy got pretty strong recently. And the problem with that is when the economy gets strong, certain things start to happen. First, you start to have unemployment go down, which it is. In fact, right now, unemployment is down to about 3.6%. In fact, just recently, there are now more job openings than there are people unemployed. And that doesn't happen very often, but if you just kind of play through that, what happens when there's more job openings than unemployed? That means employers will have a hard time finding people to come work for them, which can be a good thing if you're looking for a job. However, that causes employers to have to pay more, so it would cause wages to increase, and if employers pay more, that hurts their bottom line. So from a stock market standpoint, from an economic standpoint, when companies start to pay more for employees and they start to make less profits, that can be a bad thing for the stock market. A good thing for people getting a job, but not as good a thing for employers and companies earning profits. So that's one thing. The other thing that can happen is you start to have inflation as well when the economy gets stronger. And when that starts to happen, the Federal Reserve will come in and start raising interest rates. And they've raised interest rates from literally almost 0% about 3 years ago, and then just today it's up to now about 2.25% to 2.5%. So what that means is when interest rates are really low, if you imagine just, if you were to go buy a car and get a car loan, which we never recommend if you've watched any of our Money Minutes, don't get a car loan, but just using it as an example. If you were to buy a car with a car loan, 3 years ago, you may have paid 4 or 5%. Now once interest rates have gone up as much as they have, you may pay 6 or 7%. Same thing with a 30-year mortgage, which is what most people get as a mortgage. Again, not what we recommend. We recommend the 15-year. But using the 30 years of mortgage as an example, someone 3 years ago buying a home with a 30-year mortgage would pay about 3.5%. Right now, that same 30-year mortgage is about 5.5%. So that means you're paying more for your car in that example, or paying more for your house in that example, the payments each month. So if you think about all the income that you bring in from your paycheck, minus all the expenses that you pay out in the form of payments, then you have less money at the end of the month. Well, that's the same thing that starts to happen for corporations. So when corporations need to borrow money, they either borrow from banks or they borrow by basically selling bonds to the public. And so 3 years ago, maybe an Apple or an IBM or whatever, any major blue chip company could have sold their bonds at about 3%. Well, now when they go to borrow money and they go to sell their bonds, it's approaching 5%. And so, as they borrow money at higher rates, that also hurts their bottom line. So those types of things can start to weigh on the market. So you have rising wages, you have rising interest rates, and those are two things that we're watching closely, which also has a negative effect in what we believe is starting to cause over the last couple months the markets to drop. Another thing that is a little bit more technical, so bear with me on this, but the Federal Reserve back after 2008, and when they had the credit crisis, they instituted what's called quantitative easing. So quantitative easing is where the Federal Reserve essentially creates money and buys bonds. And the reason they do that is to keep interest rates low. But the problem is you're essentially creating money out of thin air and you're buying bonds. And so they did that from 2009 to 2014, and that was meant to stimulate the economy. Well, starting about a year and a half ago, they started to reverse that. So when you reverse it, it's called quantitative tightening. So they did quantitative easing to stimulate the economy. Now they're doing quantitative tightening to reverse and kind of normalize the economy. Well, if you kind of I like to use the analogy, if someone's on steroids and they work out a lot, they can get really big and strong. Take the steroids away and what happens? You know, they essentially deflate and they lose their strength. So that's what's happening right now with the market. If the Federal Reserve did quantitative easing to stimulate the economy, and now they're reversing that, they would seem to have the opposite effect, where it would destimulate or potentially hurt the economy. So that's another thing that's going on behind the scenes. I've gotten a few questions over the last few weeks about the yield curve flattening, or even what's called the yield curve inverting. And so just a quick kind of real simple, trying to understand. You don't have to understand all the technical sides of it, but just so you understand what the meaning of it is. Usually, and we wrote about this in our second quarter market commentary, but usually when the shorter term interest rates, we're talking about government bonds, like a 2-year government bond, the U.S. government bond, would have a lower yield than a 10-year U.S. government bond. That would be normal, okay? And usually in a strong economy, those are pretty far apart. But prior to the last 5 recessions, the shorter term yield, in this case the 2-year yield, got higher than the 10-year yield. Okay, that's called an inverted yield curve. And when that happens, that's predicted the last 5 recessions. It hasn't officially given that signal yet, but it's very close to giving that signal. And so that's something we watch closely to see if we're going to go into a difficult economy. So you have that going on in the background as well. Another thing that is come across our radar that we've been watching actually since kind of February timeframe is, I'll show you a quick chart actually. If you look at the S&P 500, just to kind of give you an idea, this goes back to August of last year. And so 2017 was very strong all the way up until January of 2018. And then most of you recall we had a drop back in February and again in April. Well, after that, we recovered and went into all-time highs on the S&P 500. And then recently, we've taken a drop, even broke below that low in February, which is possibly a negative technical sign. But, okay, if you kind of keep that chart in your minds and then look what's going on internationally, now I'm bringing up the all-world index, so basically all international markets except for the U.S. So same strong 2017 going into the February of 2018, then they fell in February. However, they never recovered. So the international markets are down over 20% from their highs. And that's concerning because Europe, for example, the ECB, their basically central bank, it has interest rates near 0%. And so if they, contrast that to the Federal Reserve in the United States, our interest rates are up at 2.25%, 2.5%. So if the economy gets bad, we can lower our interest rates to stimulate the economy. The European Central Bank basically has their interest rates at 0. So if they go into a recession, there's not much they can do. So that's a bit concerning, and the market has already started to factor that into the price. Unemployment in Europe is near 8%. That's not a good thing. So that's something we've been watching closely. We've actually really kind of tried to steer away from international and reduce international. Our portfolios have less international than a typical diversified benchmark. So weak international markets is another thing that we're concerned about. So what are we doing about this? Number one, it's very important just for everyone to understand what our investment philosophy is. So we manage risk first. We try to preserve our clients' assets first, and then secondly, we try to grow it. Okay, so we're much more concerned when we manage money. Our philosophy is to make sure we never take a big hit. Okay, if we can do that well, then you can do okay. You can do okay on the upside as long as we hold on really well on the downside when the market goes down, and then our portfolios should do well over time. So just understanding our investment philosophy is one. Number two is not all parts of the market are going down right now. There are some other areas that are actually going up, and it actually tends to favor our portfolios. So a couple areas that have been going up, parts of healthcare have been going up, and mainly non-cyclical companies. So companies that are not affected really by the economy. So if you think about like food stocks, hygiene stocks, those types of companies, they've actually been going up as the market's been going down. We've been trying to stay away from this year some of the what we felt was the highest risk areas. It hurt us at the beginning part of the year because we missed out a little bit, but now it's helping us. What we thought was the most vulnerable area was the high tech, high growth stocks. And so your Facebooks, your Amazons, your Googles, the high flyers over the last 5 years, they got up very high. So we've been trying to avoid that. They've taken a big hit now, and the money that was in those stocks has been rotating to the defensive nature stocks, which we're more invested in. So that's one of the things that we've been doing. We've been trying to avoid the risky areas, trying to be in the areas that are not as risky and that do better during a bad time. Number two is we've been really since early October, we've been getting out of stocks, reducing stocks, okay? Not getting out completely, but just reducing stocks and increasing bonds. One of the things that's good about the potential for a recession in the future is that after the Federal Reserve raises rates, when they think a recession is coming, they'll stop raising rates and they'll start to reduce rates. And when that happens, bonds tend to do very well. And the smarter money always looks out a year in the future. So we're trying to anticipate what the market's going to do for a year from now. And if we do go into a more difficult market in 2019 and 2020, then the anticipation would be that the Federal Reserve would start lowering rates, which means that bonds will do better. So we've been increasing bonds. And if you look right here, this is the aggregate bond index. This is the October time frame when markets started to drop, and you can see in November and December, it's actually started to go up during that time. So bonds have actually been going up. So we've been trying to reduce stocks, increase bonds, and even use a portion of bonds, even in our aggressive portfolio, just to kind of hedge the stocks that are falling, to have a portion of the portfolio that is going up. And specifically, bonds have been going up during this time. Another thing is another good thing with interest rates being higher is money markets actually have a decent yield. So our money markets are getting over a 2% yield. So we've been just putting a little bit more money to cash and holding off until the market gets lower and having that money, earn interest. Another point I wanted to make is that it can be very difficult with the news media, just with people around you, that when things are going down and the market's going down, your emotions can get the best of you. So try to avoid that temptation to make any irrational decisions. Some of the worst investment mistakes have been made at some of the highest emotional state of minds, if you will. So when the market's going down bad, on a big down day, someone may call and say, I just can't take it anymore, I gotta sell. Really try to avoid and resist that. If it gets bad, you want to call us to walk you through that. We're happy to do that. That's what we're here for. Also understand that markets go up and down over time. That's what they do. And so if you're putting in money every month, whether it's into your 401k or your IRAs and stuff like that, this can be a really good thing. So, if you're putting in a set dollar amount every month, what's called dollar cost averaging, you're buying shares as they go lower. That can be a good thing. So, but no matter what your circumstance is, just know that we're trying our best to protect your accounts and grow them over the long term. But right now we're in a defensive posture, trying to protect as best as possible. And then when we think things that look better going forward, we can reposition and try to take advantage of the market going higher. So I hope everyone has a great holiday. We wanted to wish you a Merry Christmas and Happy Holidays.